So today I want to talk about news that's not on the news but should be on the news and a lot more. So the first one I want to talk about, it's been going on for a few weeks now, 4 weeks, is the ECB and the Swiss National Bank accessing their currency swap lines with the Fed. What does that mean? Is basically we're seeing some issues with some banks potentially in Europe. So everybody has, a lot of the major banks have currency swap lines with the Fed so they can exchange currency that is used to help each other out in moments of crisis. So the reasoning why is basically all of these banks have a dollar market, or basically an auction, and they sell dollars to their local banks. When things are normal, nobody shows up to these dollar auctions where the Swiss bank or the ECB sells dollars and receives assets, and then they flip them back to each other. So, like, basically a repo operation. So usually there's nobody that shows up. The last 4 weeks, we've been having people show up, and more people show up and asking for more money. What does that mean? That means that normally you should have nobody because the banks have no issues getting dollars. They have no issues going to another bank and swapping out assets for dollars. So if there is a counterparty risk, do you want to give somebody your dollars or your assets and vice versa? So that means banks are not wanting to lend to each other. And that's a little scary because that's usually a financial, hiccup, crisis, whatever you want to call it, depending on the severity of it. So if banks can't get money between each other, they have to go somewhere. So they have to go to the central bank. So they go to these auctions, dollar auctions. And normally, nobody shows up. The last 4 weeks, we went from 3 banks to 17 banks. We went from $3 billion asked to 11.5 or 11.6 billion. Not a huge amount, but it's like, hey, it's just when the normal amount is supposed to be zero, it's a concern. And this is just the Swiss National Bank. The ECB also did the same thing. So something you need to monitor and see if we are looking at some issues in banks in Europe. We don't know which bank because it's anonymous. So could it be Credit Suisse, Deutsche Bank? Could it be UK banks that have operations in Switzerland, and they're trying to not be visible in what they're doing, trying to get some dollars that they can't get? We don't know, but it's something that needs to be monitored. It's very important. So watch those Fed currency swap lines with the ECB, Swiss National Banks, and others, and see if there's issues there. And then look at those dollar auctions at those central banks around the world and see if there's an issue there. So that's one thing, not on the news, but should be on the news a lot more. Another thing that's not on the news is Japan. Yeah, Japan is in trouble. Yen hit almost 150 to the dollar. That is the worst performance since 1985. And that was the Plaza Accord, by the way. That was like a major shift. So on Friday, the Bank of Japan had to intervene. They started dumping some dollars and some treasuries in order to shore up their currency. So my fear is we could be seeing a reverse currency war, where some countries are trying to defend their currency as their values are being crushed and they have no choice. So far, the bond market, Bank of Japan is like being stubborn. They want to maintain low rates or negative rates. I don't know how long they can do that. And if there's a crack, we could see some major issues there. Sovereign default, I don't know, probably not, but it could be very, very painful for Japan. And if it's painful for Japan, it's not a small economy. It's a major one. So yeah, so it could snowball and ripple across the Pacific to the United States and to Europe. So yeah, it's disconcerting to see Japan having these issues. One of the most stable economies in the world, seeing these issues where their bonds were their currency. The third thing that was super interesting was Secretary of Treasury Janet Yellen coming out and knocking on doors at primary dealers, asking them if it was a good idea to sell them and buy from them bonds, treasury bonds. Very, very interesting. So it's a new operation that would basically create a second central bank alongside the Fed. We just saw that in the UK, where UK pension funds got into huge trouble a few weeks ago, and the Bank of England basically came out and started like swapping out bonds, older bonds for newer bonds, basically on the run newer bonds and off the run older bonds, in order to create some liquidity into the market and helping them out. But that doesn't create money printing, because you're just swapping out old bonds for new bonds. So at the end, it doesn't affect didn't affect the pound. It didn't affect BOJ hikes and interest rates. So if the Treasury does that, that means we're gonna have QE without having QE. So that means they're gonna go and save the pension funds, the primary dealers, the banks, large institutions that are holding longer term bonds, swapping them out with newer ones, probably more in the shorter end, in order to give them liquidity, but not really changing M2 and changing the amount of money out there. So they can let the Fed continue to tighten, continue to raise rates to fight inflation. So that's a very interesting development. If they put this operation in place, it could be very, very dicey, because that means the Fed is not going to pivot. It's going to continue what they're doing. The banks will be fine. The primary dealers will be fine. The big institutions will be fine. But everybody else won't. That's the important thing. That means if the markets think that the Fed's going to going blur and printing, nope. The Treasury is just going to swap old bonds for new bonds, and then that's it. Just liquidity in the short term, because shorter end and newer bonds are a little bit more liquid than older bonds. So it shores up their balance sheets, shores up their liquidity, but it actually doesn't affect liquidity. So interesting thing. So those three things really you have to monitor and see what's going on. And but so far there's no change. Fed is still going to hike some more and continue hiking until inflation is beaten. And when that is, okay, maybe sometime in 2023, but that means something's gonna break. So hold on to your hats. It's gonna be a bumpy ride in the real estate market and stock market. Let's hope for the best, prepare for the worst.